Welcome to Skills to Pay the Bills. I'm Tia Young, your host. Today we're going to focus on index annuities and how to know when you need to really have one. Our returning guests are Shirley Luu, Executive Field Chairman for First Financial Security, Inc., and also host and co-producer of The Real Secrets of Money. We also welcome Mr. Bobby Lee, Senior Marketing Director for First Financial Security, Inc. Shirley and Bobby, welcome again to Skills to Pay the Bills.
Well, thank you, Tia, for having me.
Thanks,
and
Tia,
Bobby,
for having
thank
me
you,
here.
and that nice purple tie, I like that.
Thank you.
Well, we're going to get right into it.
Okay.
You both have been on the show many times over the past year talking about different safe money type products.
Yes.
And today we want to focus on annuities. Shirley, as a refresher, can you share with our viewers, exactly what is an annuity contract and how many different types of annuities are there?
Well, Tia, annuity is basically a contract between the insurance carrier with the clients, and it depends what kind of contract they enter into. As a matter of fact, like, okay, I promise you in exchange, as an insurance company, will give you a certain amount, guaranteed or not guaranteed, if you happens to do investment with me. Okay. And that annuity payment could be payout monthly, yearly. It could be payout in a certain amount period, 5, 10, 15, or 20 years, or it could pay out lifetime. And so it's really going down to, well, what is appropriate and what is the right annuity for a client. You have to kind of do a needs analysis,
Right.
And then there are also, different type of annuities, like you had asked me about. There could be fixed annuity, and there's also a fixed index annuity, and then you also have the variable annuity. And all those plays differently in the roles of when it comes to investment and savings and all that. How secure do you want your money, or how risky do you want your money to be?
Okay, so you have something for those people that are kind of risk averse and they don't want to take any chances.
That is correct.
Okay, all right. Now, Bobby, you've been on the show and you've taught on several different types of products. Is there anything new out there on the market with respect to annuities?
Well, as far as annuities, as Shirley said earlier, we have our fixed annuities and our variable annuities. But the emerging annuities, which act very differently from the old traditional annuity, is the index annuity. Okay. And within this index annuity, what happens is that, you get the market returns, but never any of the losses. Okay, where the insurance company used the market as a benchmark to credit your account according to which index you choose. But more importantly, within these index annuity, they have certain riders that comes with it, where it offers you a long-term care kind of like a policy within that annuity also. It gives you the lifetime income, and it has certain guarantees that the older annuities does not offer.
Right.
So these are the new features within it, and like I say, with the long-term care, what they call that is like the well-being. Like, let's just say if you get a guaranteed lifetime income, it's like $20,000. But if you ever happen to are disabled, or if you need the long-term care where you can't perform like you can't feed yourself, or dress yourself, they can turn around and give you twice as much income for 5 years to take care of you. So, I mean, that's the beautiful part, that you have an annuity that actually takes care of you when you get hurt. So, that's something that's very new, right, that a lot of companies don't do. But because we are a broker, we are constantly, research and look for, companies that offer the best of the best to give to our clients.
Right. Well, Shirley, I'm just going to be honest with you. I have an annuity contract, and I know just a little bit about annuities. But I got to tell you, every day my mail is just bombarded with so many different companies, annuity companies talking about the contracts, and some of them are index and some of them are something else, and where one picks up, another doesn't do that. And I mean, how is anyone to know what they need? I mean, how do you go about helping someone who is not in the business, is not an agent or not a broker?
You know, I'm glad you asked that question because I get that all the time when I sit across clients. How do you know? And believe it or not, even within fixed index annuity, even the same type of brand name, it's still not the same. Not all index annuities are created equals. For example, bonuses. Some say, okay, I'll give you a bonus 10%. And Bobby can probably elaborate what I mean by bonus is not all the same.
You know, like certain companies, they might say, hey, I'll give you 10% bonus or 20% bonus.
20%? You got some companies giving 20%?
Yeah, but there's always a catch to that. You know, certain companies 10% bonus, but then you get it the next day. Versus another company, you might have to be vested for 10 years before you get, you know, you get a little portion, a little time. You know what I mean? So what happens is a lot of people, they see all these companies with these attractive offers, but they don't read all the details. See, with us,
fine print.
Exactly.
It's the fine print.
And with us, we deal with these companies all day long. I mean, we have over 300 companies that we can access and learn about all this. So we've done the research so that, you know, we can show them side by side why you would pick one versus another. And like Shirley said earlier, it's more of a situational, and you know, it depends on what the client needs, and you know, when they want their money, how much they want, and we basically sit down and go through all of that as far as their situation before we can even suggest anything to them. And you know what? We offer a free consultation to do that, where they can come talk to us. You know, there's no obligation or anything, and we will, you know, understand their situation and show them different options that is best for them.
So let me just ask, if I would call either one of you up, you know, ring-a-ding, ring-a-ding-a-ding, you know, I hear about this new annuity contract. I want somebody to come out and talk to me. What would that process be like when you get to my house after we set the appointment up? When you get to my house, or I come to your office, or we meet at I don't know, Starbucks or someplace. What would that analysis? Is that what it's called, an analysis?
Yes, financial analysis.
Financial. Yeah. So what would that analysis be like? What would I have to have?
Well, it's important. Coming to see us is like going to a doctor. Okay. When you go to a doctor, one of the key things is you would tell the doctor where you're sick, right? Well, I'm hurt here, I'm hurt there, here are my symptoms, this is what I'm looking for, and here's how you can help me. Well, with us, it's the same thing. If you came to me, you would say, well, Shirley, Bobby, I need to retire at this age. I am this age today. This is how much money I have, and here's why I have it. I like to see if I can get this much money out when I am retired this age. Well, I want to make sure it lasts me for life. You know, what's my shortfall? You know, what are my opportunities that I can put in extra money to be able to live in the lifestyle that I live today? So if you come to me, I would look at what your current finances today. You know, where do you have it? Is it risky or not risky? Does it have guaranteed lifetime income? Does it have the well-being? The kind of things that Bobby talked about, because all those kind of things play a very important role. And even if you did have an annuity, we do side-by-side comparison. Bobby calls it my T-Bob. I always like to draw a picture T, one of those, the current and the new, old and new. If it makes sense where the new is a better product or services, we do. If not, the old one you have may as well, you know, stay where you are. So that's what we do. We're more of a, you know, kind of money doctor. So.
Okay. So well then, okay, so you're here in my house. How should I prepare for your meeting? What kind of documentation do I need in order for you to be able to make the analysis that, hey, you need to make some changes here? You know, like you said, you didn't read the fine print on what you already have, and do you know that next year this and such is going to happen? I'm like, oh, I didn't know that. You know, what do I need to have to prepare for you?
Basically, when we sit down with clients, we want to have all their financials ready. Let's say they have a certain amount in a 401k or an IRA, or they might even have money in an annuity. We need to find out all of this. And there are times I might sit there and call up to those companies, understand, what surrender charges are involved, or understand, how their money's allocated and, what it has been making, what are the fees. So we explain to our clients first what they have and where that's going to go in the next 5-10 years, and understand where they want to be, in the next 5, 10, 20, 30 years, in order for us to kind of, give them a proposal of, hey, you know what, I think this would be the best based on everything you share to us. So basically, we would want you to have ready all those financial statements so that we can contact them, we can look at it, we can understand, because if we can understand what you have, we're not going to be able to recommend you something that will benefit you later.
Right. So this is not the kind of interview. This is a serious, somewhat complex interview. It's not the type that you can walk in 10 minutes and give someone an analysis. You have to be able to probably spend at least an hour, maybe a couple of hours going.
We have.
To sit down and do that. And Bobby, you said one thing, and I don't know, Shirley, if you can speak to this. You mentioned about surrender charges, and I know not so long ago there was a woman. I'm not sure whether this was a life policy or whether it was an annuity contract, but she had taken some money out of it, and she didn't realize that maybe she had taken a little bit more out than what she should have taken out, and if she didn't hurry up and pay back X number of dollars, she was going to lose that policy. Are those the kind of things that you can look at and say, hey, your policy?
The interesting thing is, yes, you need to take a look at the surrender charges. That's very, very important in any part of contract. How long is the surrender charge? But then again, sometimes even if some company that's giving you a long surrender charge, it doesn't mean it's a bad thing.
Okay.
I mean, there's reason why behind it. Well, maybe because some companies, where they do give you a lot of money upfront with the bonuses and things like that. So therefore, if you were to, put the money in today and tomorrow you want to take it all out, they don't want to lose all that money,
Right.
So that's why they may have a longer surrender charge.
Right.
But what you got to look at is the underlying, what does all the benefits that annuity does? Right. Does it give them lifetime income? And even with that, you may have an annuity out there that has lifetime income, but guess what? Lifetime income is not the same on all companies.
Right. Well, Shirley, hold that thought. We're going to take a short station break, and we will return with our special guests, Shirley Luu and Bobby Lee. So don't touch that dial.
They say it takes a village. We focus on the truth about things that are happening in the DMV through the voices of the people who live, work, and play on Main Street. Tune in every week to discover how the community is coming together for the greater good of every resident.
Welcome back. You're watching Skills to Pay the Bills with our special guests, Shirley Luu and Bobby Lee. Shirley, before the break, we were talking about surrender charges and some of the things that happen when people get bonuses, 10%, sometimes they're 5%. Is that money that people can take out immediately, or does it have to be vested?
Well, you know what, that all depends on what company you go with and, which contract you choose. And one thing about us, is that, we've done all that research for the client already. And another thing is that the contract, all the stipulations, all the rules, all the guidelines, everything is in the contract. And we tell our clients, take it to your lawyer. It's all there. So it's very black and white. And it's our job to be able to point it out and explain it to the clients. And, like Shirley said earlier, all the surrender charges are a little bit different. You might have a 5-year, 10-year, it might even be longer than that. But it's our job to see which annuities is best for the client depending on their situation. Okay?
Well, annuity contracts, are they really designed for people to take them out this month and then 3 months later take money out of it? Because I'm hearing some people, that's what they're thinking. They're thinking that, you can get this annuity contract, they're going to give you 20%. I'm going to put X number of dollars in, but 4 months from now, if I need to use that, I can get that 10% out. And I'm thinking maybe this is not the type of product that is designed for that.
Well, here's a couple things. Okay, first of all, believe it or not, in the olden days, when some company gave 10% bonus, they forgot to put stipulation in there that, well, you can't take it out right away. And so the contract was kind of open-ended. And so there were so many clients going in, taking the 10% immediately, using it right away. So the insurance company got smart. They go, whoa, 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 we have to really, say, no. You have to wait for so long before it's vested, or, if you do take it out so early, you get surrender charge. The other thing is that when people look at surrender charge, they worry about that. Yes, I say worry, but then again, think about your 401k. If you're 40 years old, 45 years old, and today you go into a 401k and you take the money out, is there a penalty that you do that early? Of course, because it's a qualified plan, just like an annuity is. Annuity could be qualified, non-qualified. However, if you take out the money early, the IRS is going to come and fine you. Before 59.5, because you still got the penalty surrender charge. So anyone entering any type of long-term retirement should know that regardless where they put it, whether it's an annuity or 401k or TSP and all that, they still got that penalty that's going to hang over their head. So unless you want that immediate, then you go into something immediate. But other than that, it's got to be long-term.
Now, index annuities, some of them have lifetime income benefit riders, and then others don't. Can you speak a little bit and kind of let our viewers know exactly what is a lifetime income benefit rider?
All right, well, as far as lifetime income, and very few companies do offer that, but the ones that do offer the guaranteed lifetime income, basically what they're saying is that if the market never made a single penny, they can guarantee the client a certain percentage compounded every single year. And after that, they can take the the total amount at the end when they're ready to retire and give them an income that will last for life. As if you had a 401k and IRA, let's say you had $200,000 and you take out $20,000 a year. Guess what? That's going to run down 10 years.
Right.
Well, but then with the lifetime income on this side with $200,000, let's say if they don't give you $20,000 a year, but they give you $12,000, they'll give you that for the rest of your life. So if the longer you live, the more beneficial it is.
Even though you don't have the money in there,
Yes.
how can they do that?
How can they do that? Well, insurance companies have been around for over 100 years through any kind of economy. And one thing about it is that they take in a lot of money, but their payout is very minimal, and they utilize that large amount to even just to make an average of 5% return. So they have more money to pay out. Okay.
And what Bobby said, actually right before I got on this interview, a client called me, and the client goes, "That annuity you got me from last year, I want to tell you what it did." And I'm like, okay, I'll prepare. I haven't looked at her statement. And she goes, "I gave you $150,000 last year, and today I have," she said, she had gotten 10% bonus, another $15,000, and the investment side made over $10,000 gain on top. And she makes over $25,000 plus.
In 1 year?
In 1 year. So she is like ecstatic on the side of the investment. Now, the lifetime income that she did, she goes, "Shirley," she said, "the weird thing is that my lifetime income, it's even more than my contract account. It's now over $180,000 plus." And she said, "Why is that?" It's because her investment on the index, when it made so much gain, the guaranteed lifetime on the lifetime income on this particular case was based on the higher value of on a compounded basis of her investment. So besides making those $10,000 gains, she's making an additional X amount percentage on top of that. So now her account balance is over $180,000, and she goes, "That is so cool." She said, from 150 up to 180.
And the best part of it is that even if the market lost, she doesn't lose anything because it's index. Yeah. With an index product, market goes up, you make money. Market goes down, they lock it in, floor of 0%. So you never lose.
That's
but
amazing.
When it comes to lifetime income, not every company offers the same type of lifetime income, and that's where
See, that's what gets so confusing for people, because they don't know what to do. There's so much out there.
Yeah, and you know what? Every company, has a little bit something different. Like, certain company might give you 5% at age, 50, or another company might just say, "I'll pay out only 4.5% or 4%." So you have to understand that. And the thing about it is that we've done all the research. We know exactly what company offers what, and we're able to show our clients all these details so that they can grasp, they can understand it more, so that they can make an educated decision.
Okay.
Whereas if they try to do their own research, they're not going to be able to find all of this information. So it's very rewarding when we can sit down, talk to people, and educate them, and be able to help them.
So when you sit down and talk to people, I know earlier we talked about the analysis, but maybe somebody doesn't want an analysis, they just want to ask you questions. Do they have to pay you a fee for you to come and sit down and talk with them?
It's a free consultation.
It's a free consultation.
We're here to educate people and basically give them more options. They never have to pay us for anything, any services that we provide for them, because we're a broker, so we represent all the different insurance company, and they're the ones that pay us to communicate this to the client. If the client have the contract, it's between the client and the insurance company, not us.
Right.
As a matter of fact, here, not only the client don't pay us, in some annuity case, I pay the client.
Really?
The insurance company pays the client for the bonus, depends on what he or she's looking for. Yeah.
So somebody could talk to us and they'll make 10% on their money.
Yeah.
Wow. Yeah.
Yeah.
That's right. Well, I keep going back to the part about people being able to access their money because of the economy that we're in. And even people that made 6 and 7 figures, everybody's having a hard time now. Going back to your example, Shirley, of the woman who gave you $150 a year ago.
Yes.
Let's say that, I'm just going to say she's 59 and a half years old.
Perfect.
Her grandson needs to go to college.
Okay.
He's $8,000 short.
Okay.
What happens if she goes into that account a year later and takes out $8,000 for her grandson's college education?
Well, under this particular one, what's called 2 ways that she can access the money. The very first.
She can access it, though.
Yes, that's correct. The first way is she can do a straight withdrawal. I'm just going you go in a bank, I'm going to take a withdrawal, and she can do 10% penalty withdrawal per year.
Penalty free.
Penalty
Free.
Penalty or penalty free?
Free. Penalty free. I should add it. Think about
now,
it.
why is she getting it penalty free?
That's just
She's only had it 1 year.
after 1 year you can get 10%.
Oh, okay. After 1 year, you can get any age limit, or it doesn't matter how old you are?
Any age limit.
Wow. Okay.
And in this particular case, because she's 59 and a half above, therefore, she really doesn't have to pay the IRS the 10% penalty.
Oh, okay.
But in that position, so she goes in, let's say, take 10% out, 10% of $150,000 a lot. It's like 15 grand. But she doesn't need 15 grand. In your case, she only need 8,000. Okay.
Right.
Or guess what? She has a second option. Instead of doing a straight withdrawal from her account, she can execute her lifetime income rider on this.
Really?
So it could literally, if she chooses to do so, she could say, you know what, this year I want to take out $8,000, execute my lifetime income, turn it on, it'll give her $8,000. Technically, she can get $10,000, whatever the amount based on her age calculation. She can have from that age all the way to the day she dies. Now to talk about lifetime income. She can actually turn on and off. She may say, you know what, he's only in college this year, he's short money this year, stop my lifetime income, next year. You can start and stop your lifetime. It's pretty neat the way the dynamic of it works. It's all about the clients now. Yeah.
Right.
And anytime if you pass before you use up all the money in there, it passes to your beneficiary.
Yeah, the old traditional annuity used to get a bad rap. It's because the insurance company would keep most of the money. If let's say you had $200,000, and you only took out 20,000 and you die and passes away and you made it annuitized, and then it's like, wow, the rest of the money the insurance get. So those are the old traditional kind, and that's why people, annuity got a bad rap name.
Right, right.
But now the industry's changed. I mean, come on, the whole industry no longer operates in the old years old industry when all grandpa and grandma used to have.
Right.
And if some of the old financial advisors out there still not offering these index annuities, shame on them.
Right.
Well, they actually can't sell these because they're not licensed to do so.
They're not licensed to do so.
And
yeah.
another thing that she touched on that is with financial advisors, they want you to invest money in the market because anytime you do that, they make a commission. So even in the years that you're losing money in your 401k and IRA, you're still paying all those fees. And I believe it or not, most of them are hidden.
Wow.
One thing with index annuities, the fees are pretty much in the contract.
Right.
Minimal. I mean, the fees could go from 0.6% to 1% maximum. That's it. There's no hidden fees. It's all in the contract, but you never lose anything.
Right. Well, I'm going to stop you there because it sounds like we need to have another discussion just on the fees so people can understand that, because I think that's a source of concern for some people about the fees. Thank you, Bobby and Shirley, so much for a very enlightening discussion on index annuity contracts. I also want to thank you, our viewers, for watching Skills to Pay the Bills. We look forward to seeing you next week. Bye-bye.